Welcome to this episode number 44 of your next trade called today Trading Plan Badly Executed. So first thing first, if you like what you see today, please put a like forward, subscribe to the channel, and that will be helping. So why this picture of chicken? Because this week I chicken out. So as I've been saying for months and months, I knew and I've been saying that the US consumer will be peaking around September, October. So this week on Tuesday, we had the retail sales from the US, which were much, much better. And after the numbers, I chickened out. So I cut my positions on both the S&P and in Europe. So I was long for short for quite a long time. So I was short in Europe and I was short as well the US through the SPY and through put spreads mostly. Lucky enough for the US because I bought those SPY puts mostly when the volatility was at 13%. I managed to make some profit on it, similarly to the European short that I had on the Eurostoxx 50. But overall, I chickened out. So I had a trading plan, which was you keep this position. It's going to be unfolding. The US economy will be struggling for the reasons that are pretty obvious, which is the end of the reserves from COVID, and as well too much money going into the system, and it has to slow down. So why did I chicken out? You have a trading plan, and are you always trading the plan? That's the question. And what happened is, you get a lot of noise, you get geopolitics that come into play. I had some personal issues as well, and I was planning, and I'm still planning to take a week off because I'm going to New York next week. So, did I want to keep the position when geopolitics is that good? Probably not. So I chicken out. I closed the position, and very much if you talk to traders, what they have been experiencing is when you close a position, most of the time they might go big in your favor just after. And guess what? Since I closed the position, it went down another 2 to 3%. But look, this is frustration first. And when you trade, you need to deal with frustration. And what makes traders pretty good is when you manage to learn from your mistakes and carry on and go the day after. So it took me a bit of time. I'm lucky I'm gonna have a week off, but no damage done. It's just to really tell you about chicken out, and this market is making up of so much noise. It's pretty hard to get immune from this noise, and this is what happened for me. But no big deal. I want now to go into more interesting and literally what is happening in the market, starting with the performance for the week to date, looking at stocks. So this is our universe, looking at the US, looking at emerging market, and everything was down 2 to 3%. Why? Because we had a risk off. So the story is still the same. It's about Israel and Palestine, where the conflict is, for the time being, still pretty much alive, and market participants are taking some chips out of the market. In terms of FX, pretty neutral. So if you look at the euro dollar, for instance, we have been trading between 105 and 106, so not much. We are waiting for the next catalyst. Bitcoin, crypto pretty strong due to some possibility in the next 2 months that the ETFs will be allowed in the US. Gold, very strong again after a very strong Friday that was 10 days ago. So now we are close to the 2,000 level, $2,000. This is the same as before. Market participants are trying to find hedges to protect their portfolio, and we're going to be talking a bit more over the next steps of what is happening. Looking at the week-to-date industry performance, left-hand side, we get the solar, the TAN, TAN, down 9%. Yesterday was a really bad day. Where you get mostly two names that brought the indexes down 9%, and one of them was down 30%. So people start to realize it's not because you invest into one industry that this industry will be making money, and that has been true for renewables. That is the same in Europe, where we got many names that are down between 60 to 80% from the highs that we had 2 years ago. Airlines, obviously the conflict is not helping. So you see all the names here that we have that are down. The S&P is roughly here. So we are almost in between for the S&P. In terms of winners, that is obviously the gold, silver, but interestingly, you got a retail that is popping up nicely. And anything that is defensive, food and beverage, consumer staples. So as we're going to see into this next slide, which is here, consumer staples here is up 0.7% for the week, so outperforming the overall market by roughly 3%. And as you do know or not know, the XLP versus the SPY was really struggling coming into this week due to the name like Costco, Coca-Cola, all the consumer staples really struggling and have been underperforming. But this week there has been a bit of a turn. Generally, if you look at 2008, when that happens, that is not a good sign for the market going forward. Real estate, same as before with the US 10 years now at 4.9% and almost touched the 5%. That is not helping the sector. IT going down as much as the sector. Consumer discretionary down 4.6%. The reason is mostly because of the weighting of Tesla, and Tesla was down 10% yesterday after their earnings. What about the rates? So rates now. That has been obviously one of the biggest drivers in the market, put aside the Palestine and Israel conflict. US 10 years at 492, so we are at 30 bips on the week. As I've been saying, it's pretty funny to see all those bonds traders, rates trader saying, it's pretty easy to trade. Be careful when you trade stocks. It's all about momentum, and I've been trying to pick the bottom over and over. So if you've been trading the bonds, you should have been making a ton of money because, the trend has been the same over and over. So funny for me, which was mostly trading stocks, when I read all this noise coming on Twitter and social media about those bonds traders, because they have been trying to find this bottom. I've been saying it's really hard. We went from 4.6% to 4.9%, close to this 5%. There is still the steepening, we are still in inversion, but we are getting closer to 0% now, which again has not been a good sign for the economy going forward. Looking at the Fed funds rate from one week to another, this is more or less the same picture. So despite Powell saying on Thursday, the expectations are normally for the Fed to be almost done. We might have a 25 bips in, as we see here, in February or around January, February, but normally this is it for the Fed. We are going into the blackout period. So the blackout period is starting today, meaning that the Fed speakers that we had over and over the last 10 days are not going to be allowed to talk. So it's similar to me. I'm going to be on blackout period because I'm traveling to New York for the next 10 days. What about the VIX? So this is the one that we are really looking at. So if you remember, for the last couple of years, bonds have been one-way traffic. They have been selling off. Yields have been going higher. So normally in a risk-off market, what you'll be doing is you'll be selling your stocks and you'll be buying bonds. And due to inflation, it has been impossible for people to do that, and actually there has been a strong correlation between the yields and the stock market. So the difficulty in these conditions has been for market participants to find the right hedges. So normally you'll be buying bonds. You can't do that. So what you do is you need to be buying protection through volatility. We do know that volatility was compressed until August, September, where you do have like many products that were built around, selling volatility to get a bit of yields every single day. What has been happening is when there is geopolitical events like we are having these days, people obviously are chasing and buying this product through volatility, and one of them is the VIX. So we see the rise in the VIX. Now we are into the 21%. We are up from 19% from a week ago. But interestingly, as you can see here, you see the VIX term structure, which is here from the spot to the November. So the November and the December are a bit lower than the spot. So in other words, the VIX terms, the VIX futures are in backwardation. Why? Because people are so scared that they are bidding for the short-term volatility, the contract that is now higher than what is going to be in the next 30 to 60 days. So very often that shows you the panic when you are in backwardation. Normally you should be in contango and having, you know, a nice slope. So this is for the volatility. Now I would like to jump into technical analysis. So I just before the call look at SPY-V versus SPY-G. So looking at value versus growth, which has been turning a bit. And I've been looking as well just before the call at how the different factors have been working. And actually anything that has been the bad tech, the companies that are not making money, if you look at ARK, the ETF has been really underperforming. So actually in this market, people have been selling the garbage. If we start with the S&P as usual, we have been testing important level and breaking important level. It is as well testing the 200 moving average. So we are trading around the 200 moving average for the S&P. But you know, the level is, despite me again cutting the position on Tuesday, the big level on the S&P in terms of volume profile is at 4,200. Okay, so that gives you another percent. That's not that much, but I think at 4,200 there's going to be a big fight. Looking at the Nasdaq has not been making new highs. So the leaders that we had before have been holding pretty well. The Russell is down and making new lows. So if you look at the market breadth, something that we've been talking over and over, roughly 50 stocks from the S&P are making the performance and will be up, you know, 20%-ish year to date, and the other 450 stocks will be flattish to down. So, and that's the same with the Russell 2000, which is down 2 to 3% for the year. So very hard for market participants to hedge their book well, because if you long any stocks, the reality is, and any stocks, I'm talking the 450 stocks versus those 50, and you hedge yourself versus the SPY, you're gonna have the double whammy. So your stock that is long is underperforming, is just not performing, and your hedge has been doing pretty well. So it has been really, really hard for the single names, unless obviously, and people, I'm pretty sure you're going to have some educators that are going to be coming with some stupid videos about return on equity. They will tell you that they have been making stupid returns, but that has been pretty hard. And if you look now at something that is interesting, which is those market leaders, this FANG, those fabulous 7 versus the S&P, as you can see for this week at least, they have not been doing that well. I mean, one of the reasons is obviously Tesla underperforming, but this is really something to keep in mind, because so far people have been hiding into those names, okay, and that has been true for the last couple of years, and this year is more than hiding. They have been doing pretty well. So when market participants are under pressure, when part of your portfolio is really losing money, at one stage you start to sell your winners. Okay, so I would be very interested to look at how those 7, 10 names, 15 names will be behaving during this earnings season. And that's important because this week we're going to have Microsoft, we're going to have Google, we're going to have big names versus the overall market. JP Morgan, as I flagged, the candle on the earnings, which was this one, was pretty bad. Now we are going into a very important level. So if you think about, you know, S&P at 4,200 for important level, JP Morgan 141 is important. So always look at the leaders and how those stocks will be behaving. CL1, not much of a move. I'm interested into gold. So gold going into the 2000 level. Euro dollar, as I said, between 105, 106, not much of a move so far. On Thursday, we got the ECB coming. Expectations are for no change. As always, it's going to be interesting on how they're going to be phrasing the recession in Europe and how they'll be looking for 2024. Dollar yen, very much one that has been holding into the 150. Everyone is looking for those stops to play out. So on one side, you get this 150, people saying, this is the stops, we're going to go higher for the US dollar. And on the other hand, some people expecting the Bank of Japan to intervene, because this is where they intervened last October when it went above the 150. Europe, pretty much weak, very bad week in Europe for both for the Stock 600 and the DAX. So we had a big move. I was short, as I said. So if you think in terms of risk reward, because as a trader I'm interested into that, actually that was not a great trade, because I was down at one stage quite significantly. I managed to be making money, but that's not the risk reward that I like. So first I chicken out, as I said, and secondly, risk reward was not good, but again, back trading is easy, and that's just the reality of a trader. So let's go back now into the newsletter and looking at this week what happened. So I'm interested first in what we have been flagging last week. So that's will have been for the next catalyst. So we flagged that we should be looking at earnings. Okay, so we had Tesla, we had many earnings, and obviously that created some moves. We get the retail sales. So the retail sales were much better. Okay, so that's a reality. The US consumer until September did very well. My view was, and is still the same, that September was the peak for the US consumer, and going forward the US consumer will be struggling. We got some confirmation for the Bank of America CEO, we got confirmation from another CEO, which was from Nestle. So many companies are telling us, in the US it's getting much harder going forward, and we should have the numbers coming down. The Fed speakers, again, Powell saying this is data dependent, so not much of a change. Interestingly, this is the weekly straddle. So the weekly straddle tells us by how much, at the start of the week, by how much the market is expecting the S&P to be moving. So market, we were expecting 1.8%, whereas we are at 2.5 to 3%. So what has been happening is realized volatility, okay, so which is the volatility that happened on the week, has been much higher than the implied volatility. Okay, and we do know that before, and most of the time, realized volatility will be lower than implied volatility. Why? Because market participants got a tendency to buy more protection than what they need. Okay, but we are now in a scenario where the market participants are buying more and more implied volatility, and you can see here. So here, this is the jump for the retail sales, where you get idiots like me who bought back their short, but at least it was a short and it didn't go long. And since then, we have been going down and down and down. And as you can see, there is no panic. This is like a trend. So if you are a trader, you'll be saying it's almost a VWAP order. So VWAP order, where you say on Wednesday morning, please sell me the market until the end of the week. And what happened is on that day we got the option expiry. Okay, so very much the market is driven by all those options, the gamma, and it's trending, and the dealers will be selling over and over. And what is interesting are two things: is the S&P futures are extremely correlated to where are the US 10 years. So looking at the US T-note through the futures, as you can see, the blue line here has been following the US 10 years. And, we had a bit of outperformance, but now we are back to where we are before. So not much of a surprise. Literally, the 10 years and the S&P are following each other. Now, something that I flagged, and I strongly advise you to go on vixcentral.com to be looking at how the VIX future structure has been over time. So here we'll be looking at Friday a week ago, and this one is as of yesterday. So as you can see, everything has been moving up. So we went from 19.2 to 20.7. So we have been moving up 1.5 to 2% on the VIX. So market participants, the way to hedge themselves is to be buying more and more protection. So the VIX is going higher, you buy volatility, stocks are going down. And in the meantime, as you can see, this is the backwardation that we are talking, because people are very scared about not very scared, but scared at least about what's going to happen into the next 30 days, 60 days, or they have very bad visibility. they need to hedge themselves, and they hedge themselves big time right now and in less in the future. So you have the backwardation, you buy VIX futures, you're buying gold, you buy silver. You can't be doing that much with the bonds. And it's pretty hard as well to do that with the S&P only, because most of the names will be names that have been doing pretty well. So overall, this is what happened for the week. So let's look at what's going to happen next week. As I said, for me, it's a week off, so I will be in New York. I will be watching from a long distance, but still gonna be watching. But what do we have? As always, earnings season. So 149 issues, 33%. So that will be for the S&P. We got many big names. We got Microsoft, we got GE, we got tons of names. We got Meta on Wednesday. So Amazon on Thursday. So if we are looking at the big names which are here, Microsoft, Google, Meta, and Amazon. Okay, and what I'm interested is implied volatility versus realized volatility. As you can see here, this is the column for implied volatility. You can be looking at it, you can calculate it, and I'm interested of how realized volatility will be versus the implied volatility. So far, what has been happening, and this is the chart that is here, most of the time, the dark blue, which is the implied move, will be higher than the realized earnings. Okay, the realized earnings moves. And that was the reality for most between 2020 to 2022. Because if you think about it, as you have a natural catalyst with the earnings, people will be buying more premium than usual. So they will be overprotecting themselves, thinking, it's going to be moving. So most of the time, if you are a market maker, this is like gold, because you know that you're going to be collecting the two. Interestingly, if we look at Q2, at the last quarter, the light blue, the realized volatility was a bit higher than, not that much, but just a bit higher than the implied move. And looking forward, for these next 3 weeks and 2 months, I'm interested into realized versus implied, because first thing first, implied is going up massively. Okay, we went from 30% on the S&P to the VIX to 21-22%. And secondly, looking at the name by names, I do know that there is a bit of dislocation in the volatility of the index and the single names, because most of those few single names, 20, 50 stocks, are distorting the overall market. So this is the earnings. I'm interested into earnings. Secondly, what I'm interested in terms of macro, I'm looking at the flash PMIs. Okay, flash PMIs that will be coming on Tuesday. I'm looking at the GDP. So GDP on Thursday, big number. I think the expectations are around 4%. Again, to me, it's the same as the retail sales. We are talking peak economy, and going forward is going to be much harder. PCE inflation on Friday. As I said, like me, the Fed is on vacation for this week, so they're not going to be talking too much, which is probably a good thing, like me not talking. Blackout period starting today, because we get the FOMC meeting on Wednesday in 10 days. We get a bit of a Fed ECB decision on Thursday, not much expectations, and the same with the Bank of Canada on Wednesday. So, and finally, the different auctions, bond auctions. So we are going from 2, 5, and 7 years. So the big one is going to be the Thursday with the 7 years with 38 billion. So that will be for the drivers. I didn't put the weekly straddle, I forgot to put it, but I will say that for the week it's probably going now into the 2.5%, but I might be wrong. As always, looking at the Israel-Palestine, there is a lot of noise. It's pretty hard. As I said, I chicken out with my shorts, and it's part of the life of a trader. Has been saying on the Discord community for the more advanced channel is trading is a lot about dealing with frustration and having the ability of first learning from your mistakes. Okay, so you get your trading journal, where you did well, where you did a bit of a fuck up, and in the meantime you need to clean your head. So even if it could be a bit painful, you need to bounce and carry on, because if you stick with what happened yesterday or 3 days ago, then you're gonna be in total analysis paralysis. So you need to move on, learn from your mistake, which is a challenge. And this is why as well, I think the community, trading community like Discord, something that we are building together, might be extremely helpful. So this is it for me for the week. I'll be in New York for this week, so it's going to be pretty nice. If you are looking for getting an investment process, something that I've been building for the last 20 years, so you get the 4x4 video series and or the mentoring for more advanced traders. For the mentoring, we are getting closer to Q1 2024, and I do know and I can see that there is interest because you want to start the year nicely. So if you have interest, please come in the next few weeks, because otherwise everything is going to be fully booked. You're going to have more content on YouTube. Please join the community if you think that might be helpful. We are now roughly 500 traders. We try to share ideas, to share process. And finally, any questions, there is no stupid questions. You can reach me either on Discord, on Twitter, or sending me an email at greg@duponttrading.com. So again, I chicken out. This is it. Market is down 2 to 3% since I bought back my shorts. At least I make money, so not a bad trade, but always a bit of a frustration. Not always, but this is a bit of frustration. So thank you for listening, and I'll see you probably in 2 weeks, not next week. See you. Bye-bye.